the 31st of October 2025. Okay, so in a very, very short while, we will be going to, by tomorrow, we're going to November already, the last 2 months of the year. And then, yeah, how fast things fast, yeah. 2026 is coming just around the corner already. So what's in store for us? Now, first of all is the news, obviously. Now, today I'll talk about the FOMC meeting outcome on the 29th of October 2025. So what's the overview? The Fed delivered its second rate cut of 2025 and at the same time signaled the end of balance sheet runoff starting 1st of December. Now, this combination means policy is now shifting from a long period of restraint towards a phase that gives more weight to risk in the labor market, even though inflation is still above target. Now, the decision was not unanimous, which tells us the committee agrees that easing is appropriate, but does not agree on how quickly it should happen. So here are the details of the cut. Now, the Fed lowered the federal fund target range by 25 basis points to 3.75 to 4.0. Now, this is the second step in what is clearly becoming an easing phase, okay? Now, the statement kept the line that said inflation has moved up and remains somewhat elevated. Now, that wording matters. Okay, it matters. It says inflation is not conquered, yet the Fed still chooses to ease because it sees rising risk to employment. Now, in other words, the labor side of the mandate is starting to drive policy more than before. So, when we talk about the end of balance sheet shrinkage, the Fed said it will stop shrinking its balance sheet on 1st December. Instead of letting treasuries run off every month, it will reinvest maturing securities. This removes a steady source of liquidity drain from the market. Now, Fed is doing this because many market conditions and year-end funding needs were tightening. So by halting quantitative tightening, or QT, the Fed is telling markets that it does not want passive balance sheet policy to work against the rate cuts it is making. Now, this is an important part of the pivot because it improves the liquidity backdrop even if policy rates do not fall at every meeting. So during this meeting, we witnessed an unusual two-way dissent. The first is the two officials dissented in opposite directions. Governor Miran wanted a 50 basis point cut, where President Smith wanted no cut. Now, this is rare. A dissent in the same direction is common. A dissent on both sides of the decision means the committee is split on speed and on how much risk the economy faces right now. Miran's position shows there's a dovish group that thinks the slowdown in jobs and the hit from higher tariffs justify faster easing. Smith's position shows there is still a camp that worries about sticky inflation and would rather wait. Now, this is the clearest evidence that the Fed is united on the destination is a policy, but divided on the path, yeah? So what about Powell? What was his main message? Now, Chair Powell repeated that the labor market is weakening. He said jobs gains have slowed significantly this year. He also said the overall outlook has not changed much, which is his way of stopping markets from assuming a cut at every meeting. Now, he pointed to higher tariffs as one reason inflation readings have picked up again. Most importantly, he said that Fed members had strongly different views on what to do in December and that another rate cut is far from assured. Now, that line, the far from assured, is deliberate. It keeps the option of a December cut open, but refuses to pre-commit. Now, why do we think this is still a pivot? Some may say that if December is not guaranteed, then this is not a real pivot. It is more accurate to say that the pivot is in the stance, not in the pace. The Fed has now done three things that belongs in the same direction. It has cut rates twice in 1 year. It has acknowledged that downside risks to employment have risen. It has decided to stop shrinking the balance sheet. All three lean towards easier conditions. The fact that inflation is still somewhat elevated and that tariffs are pushing prices up makes the Fed more data dependent, but it does not undo the turn that has already happened. So how to read the inflation language? The statement said inflation has moved up and remains somewhat elevated. Normally, that kind of sentence comes in a hold or hike meeting, right? Not a cut meeting. This is what makes this decision interesting. It shows that the Fed is willing to ease even while acknowledging inflation is not fully back at the target. And the reason is the labor side. So rising unemployment risk now weighs more than the recent uptick in prices. That is classic dual mandate balancing. So the implications for the market is simple. For the rates, short-term interest rates like the 3 months to 2-year treasuries usually fall a lot when markets think the Fed will keep cutting, okay? Because traders try to get ahead of those cuts. Now, Powell said December cut is not a sure thing, so traders cannot price in a long series of automatic cuts right now, which means short-term rates will not drop as sharply as they otherwise would. The yield curve is just the line showing interest rates from short to long maturities, and in normal times it slopes upwards because long-term money costs more than short-term money. So if short-term rates suddenly fall a lot, the curve steepens quickly, which is the market saying the Fed will have to ease a lot, often because growth is getting weaker. Now, Powell's message stops that sudden steepening of the curve. For the dollar, market has expected that the Fed to sound very dovish and to lean quite clearly towards another cut in December. Instead, Powell said December cuts was not a foregone conclusion and reminded everyone that inflation was still somewhat high. That made the decision feel like a hawkish cut. Okay, a hawkish cut keeps US short-term yields, which I explained just now, a bit higher than traders had hoped, and higher US yields tend to support the dollar. There was also a quick rise of reaction because the meeting showed a real split inside the Fed and because Powell said the outlook is foggy. When market feels uncertain, they often buy dollars first and ask questions later. So you got the first push up in the dollar. You've seen that also as well. Now, during the Asian market hours later, after the FOMC meeting, traders had more time to think about the other parts of the decision, which was the end of quantitative tightening in December. And that side of the story is more dollar negative because it improves dollar liquidity. So the dollar gave back part of the gains that you've seen. Let's wait for the next 24 hours later on to see whether the bear or bull wins the narrative. Okay? So we'll see. Later tonight, when the US market is open, we will have a better idea who's going to win. As for equities and credit, when the Fed was doing QT, it was letting its bond mature without replacing them. That forced the market to buy more new treasuries every month. Think of it like the Fed slowly handling a stack of government bonds to everyone else and saying you deal with it. That steady extra supply can put pressure on prices of other assets because money has to go to those bonds first. Now that the Fed say it will stop shrinking its balance sheet, that extra monthly pressure goes away. Investors do not have to keep making room for more treasuries, so they can put more money into stocks and corporate bonds. That's why people say ending QT is good for risk assets. But the meeting was not a simple green light. There were two opposite dissents, which tells investors that the Fed itself is not fully agreed on how fast to ease. On top of that, the statement still said inflation is somewhat elevated. Put those together and the message is this. The Fed is making conditions friendlier for markets, but it's not promising to keep propping up stock prices if inflation rises again, or if data improves. So it helps, but it's not a guarantee. Okay, so what we're seeing right now is more like a uncertainty in a few things. But one thing for sure, if you're looking for reassurance, right, the fact that they are stopping QT, that alone can give some tailwind to risk on assets. Okay, so stocks, the US market, you will see an improvement in it. And by December, and if still they have a cut, if it shows that they have a high probability of cutting, then you will actually see prices recover much earlier. So that will have to depend on a few things. So if the non-farm payroll, the data comes out and we still have a weak payroll, and on top of that, we have an inflation coming in November, showing 3% or below 3%, then yeah, you will see a December cut happening. Okay, so let's wait for that. With that, that's the report for today.